Hi, I'm Paul.
I'm Elise. In this video, we'll break down the relationship between risk and return.
Investors often want to maximize returns, but there's no such thing as a free lunch. It's important to understand the levels of risk you might be taking on to get these returns. Generally, you're compensated for taking on additional risk over time, but there are many nuances to this.
It is very important to make sure that you are not taking on too much or too little risk. The appropriate amount of risk to take will vary from person to person. If you take on too much risk, it can make you feel uncomfortable, which can lead to investment mistakes. However, if you take too little risk, you might be leaving money on the table.
Let's just say that Jim and Pam are both saving for post-secondary school in a couple of years. Jim's noticed that cryptocurrencies have been doing extremely well over the last few months, so he decides to put all of his savings into Bitcoin. Pam, on the other hand, recognizes the risks associated with Bitcoin and decides instead to invest her money in cash and bonds.
Now suppose that over the next couple of years, Bitcoin sees extreme volatility and the price falls significantly. By the time Jim needs the money to pay for post-secondary school, he finds that he has much less than he started out with and does not have enough money to pay for school. Meanwhile, Pam has slightly more than she initially invested and can pay her tuition comfortably. This simple example highlights the importance of matching the amount of risk you're taking with your time horizon. No one can control the future, but what you can control is the amount of risk you're taking so that you avoid getting caught off guard, like Jim.
When you're building an investment portfolio, it's important to consider which asset classes you're investing in, because each of them will have its own unique risk and return profile. Traditional asset classes range from cash and fixed income, which include things like government and corporate bonds, to equities, which include larger company stocks and smaller company stocks, to list a few examples.
Each of these asset classes will provide investors with different potential risk and return profiles. Over the long term, cash and cash equivalents are generally the safest in terms of potential risk, but also typically offer the lowest returns. If you invest in stocks, they normally carry higher risk than cash and even bonds, but they generally provide higher returns. As you are building an investment portfolio, you should consider diversifying among a variety of asset classes so that the total amount of risk you're taking on is appropriate for you.
So, what does it mean to diversify? Well, diversification is the process of owning many different asset classes or securities to limit your exposure to any one individual risk. As the old saying goes, don't put all your eggs in one basket. For example, if you have an all-equity portfolio, you could diversify your investments among different industries, regions, and company sizes. This could help reduce the impact of things like unique company-specific events or even country-specific events.
Let's say that you're passionate about video games and you want to invest in a company that creates your favorite game because you think it'll be successful. If this company is coming out with a new game that is expected to be the new blockbuster game, but no one plays it, the stock might take a hit, and if that is all you own, you have concentrated your risk and potential return there.
Now, let's say you're also into fashion and you want to invest in that industry as well. You can create a diversified portfolio by investing in some gaming stocks as well as some clothing companies. Doing so will allow you to spread the risk across different companies as well as industries that aren't necessarily related to one another. This will allow you to get access to different risk and return profiles, which can provide you with more diversification benefits.
We're talking about diversification among stocks here, but another way to create a well-diversified portfolio is through the use of different asset classes. You can have a blend of fixed income and equity exposure, for example. If you are looking for a lower risk option but still want to generate returns, you can split your portfolio with 60% fixed income and 40% equity, for example, since fixed income is generally less risky or less volatile than equities.
If you're looking to increase the expected return, you'll most likely need to increase the expected risk. To do so, you can lower the fixed income exposure and increase the equity exposure to, let's say, 40% fixed income and 60% equity. The idea being that traditionally, the more fixed income exposure you have, the lower your expected risk and expected return will be. If you increase the exposure to equities and lower the exposure to fixed income, you could achieve a higher expected return, but that will also come with a higher expected risk.
One of the main reasons diversification works is because different securities and asset classes behave differently from one another. Correlation is a statistical measure used to determine the strength of a relationship between two assets and the extent to which their performance tends to move in the same direction. Low or no correlation means that the assets do not appear to be related to each other.
Few asset classes exhibit strong correlations to each other over long periods of time, which illustrates the diversification benefits of a portfolio that is varied among them. For example, the diversified portfolios that we mentioned earlier work well because stocks and bonds tend to have a low correlation to each other over time.
To summarize what we've learned, with any investment you explore, you will need to weigh the potential return you would like to make, along with the risk you will take to achieve it.
Each asset class will have its own unique risk and return profile. As you begin to build out an investment portfolio, it's important to consider how you could diversify among different securities and asset classes to make sure that the total expected risk that you're taking on is appropriate for you in terms of what you're comfortable with and in a way that it aligns with your goals.
Now that we've covered the relationship between risk and return, tune into the next video to learn more about investing.
Thanks for watching.